So I'd like to call up our speakers, Joel and Matt and Tracy. And Joel is going to give us an overview of the economy. Matt's going to talk to the life science national scene, and Tracy's going to bring it down to home turf in Philadelphia.
Well, thank you for having me. Appreciate it, Nancy. First, let me make a couple of quick comments. Housekeeping. If you see me looking at my watch periodically, we've been given 7 to 10 minutes to talk, which for me is a bit of a problem because it's been said it takes me 15 minutes to clear my throat. So I don't, for me, I could finish the rest of this time and have a lot more to say, so I want to be as careful as possible. So it's not like, I'm bored, I gotta get out of here. I gotta get out of here at least to let the other people talk. So please keep that in mind. The other housekeeping issue is that I'm an economist, and I'm really bad with numbers, so I don't have any charts or tables, okay? And I'm not very technically, skilled, so you're not going to see a PowerPoint here. So I just like to talk and discuss things. And what I want to discuss for the next 3 minutes now that I've worked is very, very quick. I'm just going to give you an overview of the economy and the financial environment that you're operating in, what the Federal Reserve is going to do, what the region looks like and the implication for that, to the life sciences sector. That's in the next few minutes. And if you believe that, I've got a bridge that I built, and it's for sale. You can each buy up to 100%, okay? I also put on Broadway shows, and I'm selling shares in that as well. So I'm going to do my best to keep this thing running on time. So if I pick up, quickly, I was a college professor for 11 years, and taught managerial economics in the business school, and the MBA students nicknamed my course Speed Economics. So if I have to rush things through, I can get through it. Meanwhile, I've just wasted the 3 minutes that I was worried about. All right, let's, since many of you, or most of you, are in one way or another, whether you are feeding into the construction sector or doing it, you're obviously worried about the cost of funding. And the big issue this year, I think that's on most people's mind, is what's the Federal Reserve going to do? And if you know, tell me so that both of us can know, okay? That was a joke. All right, that was a bad joke. That's another thing I gotta warn you about. I always used to warn my classes that I told bad jokes, and they were required to laugh. But it's all about the Fed, and a lot of people have been expecting the Fed to lower rates very, very soon. I have a very different outlook as far as the Fed is concerned. And I want to give you kind of a quick way to understand what the Fed is thinking as far as when it's going to start lowering rates. And it's likely to it is going to lower rates unless something really weird happens this year. But the question is not if, it's when. And for most of you, you've taken statistics at some point in your career. I used to teach statistics. I still know nothing about it, but I taught it. There are things called type 1 versus type 2 errors. Familiar with that? The idea that you can do something, that you shouldn't have done, which is a type 1 error. Or you don't do something that you do something that should not have been done, or you don't do something, but you should have done it, okay? Those are the two errors, type 1 and type 2 errors. The Fed is facing a situation where it's looking at inflation. Now, inflation got totally and completely out of hand as a result of COVID and the reaction on the part of the government to COVID. So COVID just basically shut things down. It destroyed the global supply chain. Transportation became a total mess. And so getting goods and services moved from around the world in a global economy almost ground to a halt. There were 30 miles of freighters backed up for the San Diego, LA harbor. It was just a total and complete disaster. That's what started the inflationary situation. The government came in and said nobody has jobs. So therefore we're going to give everybody money, whether you need it or not, take it. And guess what? Everybody took it. All right? And they suddenly had all this money and they started spending, which for an economist is a total disaster. Why is it a total disaster? On the one hand, supply chain had become totally tangled, and we couldn't get goods, let alone move goods to either produce or supply everything. So the level of supply disappeared, while, believe it or not, the level of demand, because we gave everybody so much money, just skyrocketed. Well, if you ever took an economics course, if supply goes down and demand goes up, guess what happens? Inflation, okay? So we had inflation, the highest we've seen in 40 years, and it was a total mess. The Fed's job has two jobs, is to basically help create the maximum employment possible at a reasonable inflation rate. That's kind of talk. Generalist talk on, well, what is their dual mandate for the situation? Well, the government was doing a really good job of providing the income out there for people to spend. Now, the problem with the Type 1, Type 2 era, on the government's part, first of all, was how much should they supply, right? What I'm talking about here is, if I could either do too much or too little. In government policy, and it should be the way you, I think a lot of you frame your decision-making in your businesses, I can do something. If I make a mistake, what kind of mistake should I make? That's the error you're going to make. Should I do too much or do too little? And the government looked at the situation, and every economist was saying, if you did too little and you fell back into a recession, where do you go from there? How much money do you need at that point? So if you're going to come out big or go home. And they came out really big. Right? So there was a lot of money flowing around. The Fed now has to deal with the fact that that created an add-on to COVID, and then other things happened. Amazingly enough, we had pricing power. Businesses suddenly found they could raise prices, even if their costs didn't go up. If their costs went up, they could raise prices as much as they want. I mean, I remember Disney saying, well, we raised prices. I guess we raised it probably a little bit too much. What do you mean you raised it too much? Did you just pick a number, any number? And it seemed to be the case going on. And every company thought that they had pricing power. And they hadn't had pricing power in 20, 25 years, and they were loving it and making use of it in any way possible. Well, suddenly the economy reopened and demand surged, and labor wasn't available. So now we had a problem with the labor markets, right? Businesses suddenly saw that consumers were out there buying everything they possibly could. And now they needed to supply it. So they went out to try and get workers. Well, workers are being paid by the government on unemployment, and they were a little hesitant to come right back in. And now we had a situation, what? Lots of demand for workers, not enough supply. Economics 101, wage price increases. And guess what? Labor discovered it had pricing power. They could demand higher and higher wages. You don't give it to me, I go to the next company, right? Okay, that's the inflation environment. For the Fed, they're looking at 7, 8, 9% inflation. How do they get rid of it? Well, the first thing is that there was a lot of low-hanging fruit that they were able to get rid of very, very quickly. once the economy reopened, ultimately the supply chain basically figured itself out. So all of the problems that was created by that were being resolved by itself. That meant that you could get the goods, you didn't have excess demand in a lot of the marketplaces. Inflation eased off. The government stimulus plans went from massive to less massive. We weren't giving people money, but then we got the infrastructure bill, which is slowly dribbling lots of money back into the economy. So now what we had was a situation where wages were going up, prices were going up, but some of the pressures on inflation were coming down. That's the low-hanging fruit that got us basically from 7, 8, 9% inflation to 3, 4% inflation, where we are right now. Now the Fed faces a very, very difficult question. They have only one tool. It's called interest rates. All they can do is raise interest rates, and hopefully those who are sensitive to interest rates will find that they don't want to borrow money or they can't borrow money, and the economy will slow down, whether it's you can't buy a house, you can't buy a car, you can't afford the capital expenditure you wanted to expand, but now it's too costly when you run your numbers. These are all the things that happen as far as the economy is concerned. It's the only thing they have. But when the economy is really strong, you still have pressures that are out there. So what the Fed is facing now is inflation that's running 3, 3.25%, 3.5%, depending on how you're measuring it, even a little less than 3%, but their target is 2%. What do? Go back to the type 1 or type 2 era. In the Fed policy, they have two choices. They can keep rates too high when they should have lowered them, or lower them too soon when they should have kept them higher. Those are the two options that they have. They're going to make a mistake. You got to assume in policy that you make a mistake. Which would you rather take? Well, the Fed has fought really hard by jacking up rates over 500 basis points, over 5 percentage points in a year. Okay, they did that to slow the economy down. They got inflation down, even though they were lucky. And how good it was, I'm not certain. Any of you read the Inquirer? Okay. Anybody read the business sector section on Sunday? Probably not, because otherwise you go, oh yeah, I read that on Sunday. That's my column. That was my business column. I write a column for the Inquirer. But the whole point about this is that in facing that question, which error should I make? Should I do should I stay high for too long, or should I go down too soon? They've made the logical decision. The cost to the economy of cutting too soon and reigniting inflation is a lot greater than slowing the economy down. Why? Because we're growing at a very rapid pace. Over 3.5 million new jobs were created in 23. We have an unemployment rate nationally at almost record lows. It's 3.7, you get down to 3.4, and I don't think there's anything below that. You're looking at a very strong economy. You're looking at wages going up faster than even the inflation rate. People have the money, businesses are doing well, economies just don't fall apart on their own. Consequently, if they can risk it, they would rather take the risk that they should stay high longer. This is not the general thinking on Wall Street when it comes to the economists. There were some economists who were talking about the cutting in the January meeting. And then when that passed, they go, well, now we're going to cut it in the March meeting. But we keep getting inflation numbers that are higher. And that's the outlook. That's the problem that they're going to be facing. They've got to get to a situation where if they start cutting rates, they don't risk reigniting inflation. What that means is that you should expect a rate cut this year, but not until later in the year. I have it the earliest at the July 30, 31st FOMC. But not strangely enough, since most of the economic panels that I'm on, all of the Wall Street economists want, okay, want that to be sooner, because they're on Wall Street, okay? The faster it goes down, the sooner it goes down, the higher the markets go, the more money they make. I'm not saying that's the way they think about it, but that's the way they think about it. Anyway, the point about the national economy is it's in good shape. There's no reason to think it's going to fall apart. And that means don't look for the Fed to start lowering rates, I believe, until the end of the summer. Maybe not into the fall, but I'm guessing it's the mid to the end of the summer as far as rates are concerned. The regional economy is doing just as well. Believe it or not, the economic growth measured by things such as job growth with the unemployment rate, job growth was faster in Philadelphia City and the Philadelphia metropolitan area than the nation as a whole. The unemployment rate was at or even below the national levels. You may not believe it because you don't hear it here. We always talk about our local area, but it's strong. So the outlook on the national economy is that it's probably going to slow down from where we had been seeing it, but it's not going to slow dramatically. And the regional economy should hold up. Now, let me have a caveat here. Going into 23, almost every economist said that we're going to have a recession in 23. Now, and guess what? We were all wrong. Now, almost every economist says we're going to have a slowdown, but no recession. I hope we're not wrong, okay? But the point about this is that the environment in which we're going to be operating in is going to be solid. Not as strong as it had been, but still decent to solid. And rates will come down, but don't expect them to come down dramatically, and don't expect them to come down right away, because the Fed doesn't want to make the error of moving too soon and reigniting inflation.
Thank you, Joel, but May would be way better. Great. So I'm going to very quickly run you through just a couple of points as reminders, but I'm just going to tell you what the headline is before I get to the end, so we can come back to this. I think we're in a generational handoff, and I think oftentimes we lose sight of the legacies that were left here before us. Philadelphia is, and always has been, one of the world's centers of biotechnology. You don't have to try to be anything. And I'm going to tell you a little bit about why that shows up. Is there anybody here from the B-Lab staff? B-Labs? 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 Okay. The first time I came on a tour here at B-Labs, I walked downstairs, and in the lobby, waiting for a meeting with Matthew Burkhardt, was the recently retired former head of global vaccines from Merck. Now, I happen to know Randy personally. I've gone skiing with Randy. Just as an incidental bit of trivia, Randy also knows the global head of oncology from Novartis, a guy who's recently passed away called Ian Malcolm, and the global head of commercial oncology from Genentech, who's since gone off to do startup things, called Philippe Bishop. They all know each other. They all work together, and they all talk. Why was Randy higher in the lobby here? Because they all want to give back. There are tens of thousands of executives in the pharmaceutical diaspora who are from here. You are, realize it or not, in the biotech mafia. You don't have to try to be in the biotech mafia. So what I want to try and do a quick contest on is who can do the best Robert De Niro face? Can anyone go, oh, pretty good, it's pretty good. Anybody got a good De Niro face? Nobody? Nobody? Okay, everyone turn to your neighbor. Pretty good. Pretty good. We'll come back to this. Okay, so I'm going to run through a couple of quick establishing facts to get us where we need to be, to give you a quick look. The lab market currently, yes, we're in a blip in the radar. I'm going to tell you why. I'm going to prove to you why this is a short-term blip. I've been in the business 30 years. This is my fourth cycle. This is the strongest I've ever seen the science, and that's really the key fundamental to watch. It's about the science. It's not about short-term pain. The construction market, unfortunately, went through an overheating during COVID, as you all know, and so now we're delivering too much new space into a bottom. It's poorly timed. It will settle out. Vacancy rates are up. I think these things are all, unfortunately, boosted by small caps downsizing, and so there's a sublease factor as well as all that delivery. So again, short-term blip. How's Philadelphia faring? Actually, pretty well by comparison to the other major centers. Now, I'm going to argue for you that you always have been in the core. The core isn't limited to Boston, San Francisco, and San Diego. Philadelphia is core. In fact, you beat all of them to this question with a little bit of a cheat. Now, the first company that was born here that became a permanent establishment in pharmaceuticals was what? Wyeth. What was Wyeth's first name? Anthony, you're not allowed to answer. I already owe you. No, the first name of the Wyeth brother, John. Funnily enough, he had two brothers, and they called the company John Wyeth and Brothers. I feel bad for the other two guys. They've forgotten the history. That was 1860. You beat Genentech by 116 years. Pretty good. Pretty good. Pretty good. Squibb was where? Mitch, you have to answer this question. Where was Squibb founded?
I know where it ended up. Princeton, but
Way before that. Edward Squibb, the man himself, 1858 in Brooklyn, of all places.
did I mention I'm from Kennett Square, Pennsylvania?
Was it a mistake for Brooklyn to drive away its pharmaceutical giant? Probably.
You think?
Wyeth creates an establishment here that lasts for obviously 160 years and is still paying dividends. The Philadelphia picture is one of those established in the biotech mafia, and I think our data shows this consistently. You can find that information in all of our reports. The author of those reports is sitting in the back, Ian Anderson. Hello, Ian. I also want to point out to you that the boundaries that you may drive across here are not really of interest to big multinationals thinking about hiring pictures, because the state line does not matter to them. The regional employment picture does. And if you're looking at the Princeton Mafia, it kind of blends together. So BMS is not that far away, really isn't. And the venture capitalists that have driven that picture, Healthcare Ventures and others, lots of big financial interests in that landscape as well. So you end up with a picture of talent that is very, I think, mutable and tolerant to driving distances and commute patterns. And again, these figures you can see in our reports. This happens to come from our talent report, which comes out every summer at the major bio event. So we're excited to be able to sort of show why big companies think about markets like this as part of their answer long term. They need to be in places like this. To speak to some of the factors that Joel talked about just very quickly, the current headwind, that's buzzword bingo, headwind, is a problem for us because it's done a number of things to the small cap end of the market. Large caps, not so much concerned. They can self-finance. The free cash flow in pharma could buy the entire biotech industry in less than 3 years. They don't have a cash problem. It's the small caps that do. There are about 130 companies pent up that could have gone public by now. This is not good for the sort of overall health of the early stage pipeline in the industry. That led to what we expected last summer was the beginning of an M&A wave, and it's still going. The problems began when we sort of look back in hindsight at the end of the bull run, which was December 2021. About 6 months of pressure with term sheets that no longer had the same valuations to them, created lots of problems for those small caps. And so sure enough, like clockwork, July of 2022, acquisition started in a storm. Roche by itself spent $10 billion in the second half of 2022, and we've seen that ever since. The flip side of that equation is a record number of companies hiring investment banks to look for their strategic alternatives, exits. Unfortunately, some of them bankrupt because they couldn't get out in time. So I think both of those things show us that the pressure on small caps because of the sort of effective closure of Wall Street is not good for the industry. However, the science is still there. It hasn't gone away. And generally speaking, when there is good science, if Wall Street's not open for them, those companies will find their way into acquisitions. Record number of drug approvals the last handful of years. What this really signifies over the long haul, so just to get out of this sort of short-term cycle thinking, is that the FDA has gotten rid of its backlog. Years ago, you would have said it would take you 2 to 3 years to get the FDA to review your completed clinical trial data. They've gotten rid of effectively all of that, and now they're reviewing trial data within weeks. If you didn't all spend your Halloween watching the CRISPR data get read out to the FDA, like I did, I don't blame you. But that is how that looks when you get a trial completed and the drug review goes in front of an FDA panel. And in that case, if you didn't see it, it's pretty striking. Does anybody see that? Casgevy, as it's now known, trade name. Here's what was remarkable about it. The sponsor of the trial came out and read their trial data, and they told the FDA, we've had a whole bunch of patients, which we will hear from at the second half of this hearing, who've been able to get back to a regular life after suffering from sickle cell disease their entire lives. The FDA panel asked the sponsor, okay, but what about adverse events? Have you had any malignant events, anything develop? None. What about after a second dose? We've never had to give one. If you haven't heard this by now, it's a cure for sickle cell disease. The entire second half of that hearing was patients saying they are cured after a life of agony and suffering. There was one woman who testified who said she was hospitalized 13 times before her first birthday, and that drug got her back to a normal life. This is spectacular, the advancements that we're seeing. Guess why Philadelphia is going through a renewal? Cell and gene therapy was born here in the 1980s. That's what that is. Helped along by something called CRISPR, an elegant design on editing genes. There were lots of problems with gene therapy leading up to that. Pretty fantastic advancement. So you are once again reminding the world that this is a headquarters of this kind of science. Seeing great signs continuing to remind us that things point up. R&D expenditure continuing to go in the right direction. Also, headcount in the scientific staffing of these companies has never really gone down. So continued strength there. We continue to see tremendous grant making as an engine for growth, driving the main clusters. Interestingly, there's not a perfect correlation. If you've studied the biotech industry, you know that Atlanta is really high in NIH funding, but does a poor job of keeping the ideas there when they're born. So they've had a number of companies like Triangle and Pharmaset go public, but no headquarters in Atlanta. They never were headquartered in Atlanta. So interesting that there's not a perfect picture here, but it does tell a good story about where science leads to some growth. Venture capital also sitting a little too much on the sidelines still. So the last 4 years, we've seen about $110 billion in new venture funds raised by existing life sciences venture funds. And so what that tells us is there's a lot of capital available. It's been sitting on the sidelines a little too long. It has to be deployed because those LPs are going to get grumpy pretty soon if it's not put to work. So this is a very good, I think, a good signal for us. We might be able to look back in hindsight and say that the bottom was July in venture funding of last year, because we can see the beginning of an uptick later in the year, especially in the early stage funding cycle. Here's the early stage funding cycle, gone way up recently. And the time that I spent at JP Morgan's healthcare conference this year, heard from a lot of early stage CEOs very confident that there is money there for them. They will be able to raise the money that they're looking for. And that's, I think, nationally true. So just one more time, I didn't see anybody win the Robert De Niro face contest. Why don't you look to your neighbor? It's pretty good. It's pretty good. Philadelphia, you are in the biotech mafia.
That was a hard act to follow, and the great part is I had assured Nancy that I would be the wrap-up, and so I will try to bring these thoughts together because even though we didn't practice, a lot of what was shared actually is some information that's in my slides. So I'm Tracy Brala. I'm the Senior Vice President of Strategy and Partnerships at the Science Center. The Science Center is a 60-year-old nonprofit. We have been in this space of inclusive economic growth, and we do that really by bringing together three ecosystems: startups, community, and health and science. And why I'm here today and what I want to talk about is some of what Matt was talking about, but it's really capital. And how do we get more capital into these startups? We do that through programming. We have a capital readiness program. So for startups who are looking to raise their first investment capital, how do we get them prepared to do that? We also have opportunities to invest in those startups through donor-advised funds, a healthcare investment fund, and then partnerships with other groups like the Angels Group. You could just put this slide as the Philadelphia Mafia, the life sciences mafia. This is the synopsis of that. The one piece of information that's not on here is information that will be published in the Science Center's Economic Impact Report, and it talks about the quality of jobs that life science jobs are. So companies that have gone through the Science Center, on average, the life science individual makes $105,000 per year. That's 83% higher than the rest of the region. And so think about that, in particular when I come back and talk about the government projects that are in place. There's some really great opportunities that will exist. We talked about it, 2023 was really hard for the capital markets. It was very difficult, broadly speaking. It was difficult in Philadelphia, not quite as difficult it was broadly speaking. While this number looks bad, it was actually in large part driven by one or two anomalies that happened in 2022. Life sciences and early stage capital fared far better in this marketplace than broadly speaking. From a Science Center standpoint, as we think about where 2024 looks like, we are cautiously optimistic, in large part for all of the things that were said. We talk a lot about, peaks and valleys. We are hoping that 21-22 timeframe was the peak, and 2023 will be a short valley. There's a resurgence in IPOs, which is really strong. We generally believe that, certainly at the early stage, some of that dry powder that's been sitting there on the sidelines was starting to have an uptick towards the end of last year. Interestingly, there are new founders that have come into this, or founders who've come in to be LPs. And so we're also very encouraged about that life cycle. In particular here in Philadelphia, many of you have heard us talk. I talked at the summit a couple years ago and said we're still really lacking in early stage capital in this marketplace. We have, fingers crossed, that we've seen some really positive activity going on. But we also expect that investors are going to be pragmatic. A lot of the deals that are happening are inside funds that have already invested in particular startups, and they have realistic valuations. They're not the highfalutin valuations that we've seen in the past. Are there any insight, any startups in the room? I didn't talk to one in the hallway, so I'm just going to skip over this slide and basically say, if you work with startups, Business 101 is absolutely fundamental for the startups right now. They need to be doing all of that blocking and tackling and not highfalutin flying. It's kind of what is that and what does that look like? I talked with a startup last week at our Venture Cafe programming that we have in CIC space on Thursdays, and this gentleman was looking to do a pretty significant raise last June at Bio, and I was trying to follow up and see if I hadn't heard anything, but just to see if anything happened that I didn't hear about. And he had, articulated to me what he articulated then is that they are self-funded, they have revenue, they are self-funded, and so they've been able to continue to do the research and continue to demonstrate results to their, small amount of investors that they have. They're hoping that this larger investment is going to come in and kind of accelerate that growth, but they're doing what they need to do in those basic fundamentals. And so if you work with any startups, I would encourage that mindset. Here's where there's an incredible amount of optimism, which is the trifecta from a government is actually happening. The region has been really highlighted from a federal funding standpoint. The Science Center is a hub, we're a spoke for 2 of the hubs with ARPA-H. If you haven't heard of ARPA-H, you are not alone. I would liken it, and they have likened it to the funding that happened in the late 50s and early 60s around DARPA. So thinking about the federal government saying, how does the United States become #1 in healthcare and invest behind those initiatives? The Science Center doing that and being this spoke for these hubs, customer discovery, and investor is actually really quite fantastic, and not for the Science Center, but for the region. The acknowledgement that Philadelphia has huge opportunities. And that is the same thing for the EDA Tech Hub, which is focused on precision medicine, so cell and gene therapy. Ben Franklin Tech Partners is leading that consortium. Again, it's really fantastic so that we keep that mafia alive in Philadelphia. From a Commonwealth standpoint, many of you may have heard that Pennsylvania has its first economic development strategy in 20 years. Governor Shapiro and Siger have announced this plan. In the plan, life sciences is one of the 5 industries that are highlighted for growth. And what's so fantastic about that is that they're anticipating over the 10-year horizon of this plan that across the Commonwealth there'll be 6,600 or 6,500 jobs that will be generated through the activity that they're planning on putting in place. And the reality is each one of those direct jobs has 6 indirect jobs that build on that. And so multiply that by 6 and think about the economic impact of family-sustaining jobs that I talked about earlier. The other thing that's really exciting from the startup ecosystem space is that one of the 5 strategies is around innovation to win. And we have not been winning from a Commonwealth standpoint as it relates to innovation. Right now, in the state, we are number 4 in the country in terms of R&D dollars that are utilized here in the space. We are number 44 in terms of startup density and number 48 in terms of total startups. So think about those 2 disparities. The governor's plan with this investment in the PA Innovation Fund and PA Problem Solvers, which is essentially a startup competition across the state, hopes to have 1,100 more startups over the course of the next 10 years. And then there are some great collaborations that are happening across the state in the life sciences sector, which I've been in this space now for 6 years, and I had not seen those collaborative opportunities happening. And then, not to be undershadowed, Mayor Parker has articulated that life science is a key priority of hers as it relates to her vision for growth for the city. So I will wrap up my remarks there. I'm happy to take any questions, but we are very cautiously optimistic that given what's happening from an economic standpoint and what's happening from a funding standpoint and certainly from a government standpoint, that Philadelphia is really poised for success.
Okay, we're happy to take any questions that any of you have for our esteemed speakers. Yes?
Mike or no Mike?
Yeah.
Can you hear me?
There you go.
Yeah.
First of all, Matt, thanks for the pep rally around Philly Mafia. Making me proud to work in pharma in Philadelphia. So I guess I'm going to direct my question to the economist. In the recent years, we saw a lot of funding from the government going to support the life sciences industry, especially around COVID. I think it was mentioned up there by Matt. What's the outlook? What's your opinion of the outlook? I'm not trying to get political. We are in an election year. Just kind of curious if you have some thoughts around what the government might do with funding in our space. Thank you.
And again, this is just looking at what's happened versus what may happen. And I started off as a microeconomist and wound up being a macroeconomist, which is pretty fascinating. But I think the biggest part about some of the reasons I've won a few forecasting awards is I understand the micro leading into the macro aspects of things. What I see that's happened in the government in the last few years has been focus, not a discussion, but a focus on the actual activities and targeting of funding towards what are perceived to be the high growth areas in the economy looking outward. And as you've pointed out so very, very clearly, life sciences is one of the high growth areas. One of the areas, look, as you can tell, I'm a baby boomer. I'm kind of like a leading edge baby boomer. And I can tell you about the need for life sciences and all the medicines and my new shoulder that I got a few months ago, and probably my new knee that I'll probably need, and all the drugs I take. And for the next 20 to 30 years, boomers are going to be overwhelming the healthcare system with these kinds of needs. And that's what this government, the current government, I think, has targeted. Instead of just simply saying, well, we're going to expand manufacturing. No, we're going to expand manufacturing in certain sectors. And while yes, there's a lot of garbage that's also involved with that because you have to get it through Congress. And unless you put the garbage in with all the steaks and caviar, you won't get any of that stuff. But what we're seeing is much more of a micro approach. And that's where life sciences come into me. And as the election comes about, it doesn't, I think there is a difference in psychology and philosophy of how government works between the two. And you gotta look at the proposals and what they're talking about, not in general, not when they get up and give a stump speech, but what the people who are writing the proposals for them are saying. And this current government has very much stuck to the micro approach, and that's the most optimistic he can possibly be, I think, for the life sciences industry. Did you want to comment?
I was just going to say, we can talk our age, but the funding there is $3.7 billion that's been allocated, and there's not an expectation that that will stop given, whatever future changes happen.
Anybody else? John?
So how do you get through the question of like the valley of death? Those companies that have early stage technology get some funding from the government. Now they're trying to get their Series A financing. It just doesn't exist, although it does exist, according to what you said. How do they get the money?
So the question is, how do you get over the valley of the death between government funding and that Series A?
So I'm going to give my little smirky comment. I tend to do this when I sit up here on panels. It's the mafia needs to get involved. So the people that are in Philadelphia who may not necessarily have been in this space before but understand the value in life sciences, getting more folks to be early stage investors will really mitigate that. My snarky answer, I don't know.
Yeah, I would just add, I think what we're seeing right now is a blip on the radar long term. It's the funding mechanism is a little bit broken, and when rates change, it'll flow a little more freely. But I think in the long run, the last 10 years, we've seen just a tremendous investment in science. And so the downside of that is there's so many products to carry in the pipeline. It's a very expensive proposition. So as I'm sure you know, there's a little bit of cocktail napkin math in venture firms, that if you're going to start a new company, if you want to deliver that company through a product, it's going to cost you on the cocktail napkin $500 million. So this is not an easy thing, and you can't shortcut that. I spent a really interesting, laughable week at JP Morgan this year with all the AI promise. You know why AI won't change clinical trials? Because you still have to do clinical trials. So I think there's lots of discussion about how great it will be for discovery. It probably could do some things to make discovery more accurate, maybe, or spot more leads and do better at generation, but it isn't going to change the fact that the FDA wants you to have thousands of patients in a cardiovascular oncology product. Sorry, can't shortcut that.
Yeah, let me just make also an economic comment about what may have been hindering some of the financial activities in 23. go back to the comment I made about at the end of 22, most economists are talking about the interest rates going up very dramatically and going into a recession. That's not an environment where you decide to put $500 million into it. I don't know whether it's going to make it kind of economy. Now the exact opposite is happening. Optimism about the economy, expectations on low rates. So it may just be the economic environment is changing enough, added on to the other things that are out there, that will be really helpful, I think, in 24. And that's why I'm optimistic about it as well.
I also loved your comment, Tracy, about the non-dilutive funding that keeps the company going when they're looking for investment capital. Very, very important. And if you can find multiple streams of those, I think your chances of success increase exponentially.
Yes.
Matt, you talked about all the things we're getting right here, and obviously none of us can control the economy, and that's the biggest obstacle right now. But what does Philly need to do to get better? Is there a thing or multiple things where it could be tax structure, incentives, it could be lack of manufacturing. What is it we need to get right? Where's the hole?
Geez, I'm really glad you asked that. I would say I'm one of the about 5 or 6 authors of a bill in Maryland to create an angel investor rebate, not a credit, a rebate for angels. And I think that's something that more states could look at to foster more startup activity in targeted industries. I think there are problems at the early stage that are intractable, and angels get pounded no matter what you do, right? So they get pounded down in later rounds. It hurts if you're an angel to go through that. So I think if there's a way to foster greater capital formation at those early, very high-risk stages, that would be supportive. I think you could look at the value chain through drug development and find something everywhere. So for instance, there will be a pinch in about a year's time in biomanufacturing. There's not at the current moment because we went through a great building wave for 2 years. Doubled the rate, tripled the rate that we were growing at, and in 2023 came back down to normal growth rate. So it felt like everything stopped. It didn't actually stop. We grew 13% or so in biomanufacturing capacity in 2023. That's back to normal. So what turns out to be abnormal is the COVID wave for a surge in biomanufacturing capacity. Normal rate sees us doubling every 5 to 7 years until the biomanufacturing capacity. So does that mean that there is a place to make all these new cell and gene therapies? No. I would argue about half of the current drugs in the pipeline that are cell and gene therapies do not have an option of supply resolved. So we have to get quicker at matchmaking that capacity. And when it's not there, anticipating the capital planning for it. There are lots of pieces in this equation, and they all have to kind of work to deliver.
New Jersey actually has a rebate program for angel investors that's been very successful.
I would add to that comment, kind of paraphrase from time that I spent in a program that Rebecca Grant from the city offered, and what we heard from life science CEOs was a lot around kind of Philadelphia as an environment. And so if you notice my comments said long-term strategy for Mayor Parker are very focused on life sciences, but her short-term strategies are clean and safe and green. And so that's very much the how do we get the city in order so that it translates into talent attraction opportunities. It's not national news and headlines of bad things happening in Philadelphia, but in fact we're changing kind of the fundamentals, and that's what her first 100 days and the first parts of her short-term strategy are around. And so I think that's really paramount and critical as to the reason why she kind of started there.
Yeah, that was, for our first symposium in Philly, that was a lot of the comments that came out of there. That just making sure the city was safe and clean and people had fun places to go and it was a good place to live. Those kinds of changes were important to nurture the industry. Anybody else? Okay, well, I'm glad to say we have an hour left to drink, so everybody enjoy.